RPF Corner. Then finally, we've been able to connect with Mr. Hemant Rustagi of Wiseinvest Advisors. Hemant, thank you for joining in on ET Now and waiting patiently by. Lots of technical errors on account of the monsoons, perhaps. But this is, of course, our personal finance corner, and of course, we are kickstarting it with Ask the Money Show. You can send in your questions and queries, and Hemant will be here to answer them. But for now, Hemant, let's talk about, budget and mutual funds. This is always a talked about topic, how mutual fund managers, etc., want the budget to be. But ahead of that, should a person who's holding a mutual fund or several mutual funds in their portfolio, should he be a bit too worried about the budget as he or she perhaps was during the elections, or are all these events just these one-time events that you have to read through, gain knowledge and then perhaps move on and not look at it beyond that?
Well, I totally agree with you. I think budget is an important event, and it's not that you can ignore it. You just must keep an eye on what is happening. But I think my view clearly is that there are going to be many important events. You have budget, you have RBI credit policies, then you have elections, and you have international events. So I think look at someone who is investing for a long term, let's say for next 10 years, 15 years, 20 years, or even 5 years. The thing is, during every time horizon that you define for each of your goal, there are going to be some events which will impact your investment, impact the market, impact the interest rates. So clearly you need to keep an eye, but you cannot be actually making investment decision based on that. The fact is that if you're investing in, let's say, equity for a longer period, yes, the budget is going to be important as to what comes out in budget, which industry will get favor. Especially when you're investing in mutual funds, you have fund managers who will take care of that. If they need to make changes in the portfolio, they'll do it for you. You don't have to make changes in the portfolio. So my view is keep an eye on an important event like budget. See how it's going to impact your portfolio. It may require you to tweak some part of your portfolio, but that's about it. I think you should not be. I've seen investors, holding their investment back, thinking that let's see what happens in the budget and then we'll decide what to do. I don't think that's the right decision. Keep an eye, but do not, kind of allow your investment decision to be driven by an event like budget.
Okay. Yes, budget should not really determine what your investment decisions should be. But folks, the phone lines are open, 24990388. We're still continuing Ask the Money Show. So call in on the number that's appearing on the top of your screens, 24990388. Or if you're shy to talk on the phone, you can email us, themoneyshow@etnow.tv, and Hemant will answer your questions. Okay, we have our very first email query from Ravi Kiran. It's a very long question, so I'm going to read it slowly. He's 32 years old, resides in Bengaluru, has a moderate risk profile. He's a software engineer with an MNC and can increase his SIP investments by 10% every year. He has a home loan as well of around 38 lakh rupees that's been outstanding, and he has a couple of SIPs of roughly around 30,000 rupees. Axis Blue Chip, Mirae Asset, Kotak Standard Multi-Cap, ICICI Multi-Cap, and L&T Mid-Cap. Now he has a couple of goals. He wants to buy a car in 2 years, worth 6 to 8 lakh rupees. Daughter's higher education, 30 lakhs, and daughter's marriage, that'll be another 30 lakh rupees in 20 years. And then he wants 3 crores in 20 years by retirement. Okay, I don't know if the 3 crore amount is going to be sufficient in 20 years for retirement, especially when you can expect a life expectancy of almost 20 years, after retirement. But yeah, we should talk about that as well. So his first question is my fund selection appropriate, or do I need to tweak them to achieve my goals? And secondly, he has an additional corpus of 32 lakhs which is parked in the SBI Max Gain Home Loan account to get interest saving. Is this a good idea? If not, can you please suggest where and how should I invest this amount? So he has a home loan, he has SIPs, and he has a couple of goals. Of course, he wants to know about the SBI Max Gain Home Loan as well. So Hemant, let's go one by one. Firstly, 3 crores is what he believes he should accumulate in retirement, which will be 20 years later. Hemant, is that 3 crore figure enough?
Well, I think the face of it, I would say, may not be enough, but I think it's very important to really see what our income levels are overall and what your expenses are, because all that has to be taken into account. So that's why I think it's very, very important that whenever you're planning for a goal like retirement planning or maybe children education or any other goal which is long term, you must consider inflation. So you need to look at what is going to be the cost, today's cost, and also then apply inflation and then see how much you would require. So clearly, I'm hoping that he is, consider inflation there. If he is not, maybe he needs to revise his target for the retirement planning. As far as the entire process is concerned, I must say that he's started off very well. I think the best way to start your investment process is to define your goals. Make sure that there's a target for each one, there's a time horizon, because that helps you in terms of deciding what your asset allocation should be. So clearly, if you look at, there are 4 goals that he has right now. There are 3 goals which are long-term, such as for daughter education, marriage, and also for his own retirement. And there is one goal where he wants to buy a car in 2 years, which is a short-term goal. Now we need to separate short-term goal from long-term goal. The portfolio that he has built is all equity funds. There are 5 funds. I think I must say that all the fund that he has in the portfolio are of great quality. It's a good mix of multi-cap, large cap, and mid-cap, so he can continue with that. Now let's come to how much he needs to invest to achieve his targets. Even if you go by his targets or whatever he has mentioned for 3 crore for his retirement and 30 lakh each for education and for marriage, for his retirement he needs to invest 30,000. I'm assuming an annualized return of 12% here from equity funds. So 30,000 for his retirement and around 9,000 for his remaining 2 goals. So totally he needs to invest around 39,000. For his short-term goal, which is 2 years, he wants to buy a car. Because the assumed rate of return have taken only 7 to 8%, he needs to invest around 31,000. So clearly he needs to separate his goal short-term and medium-term. He's investing 30,000. There is a shortfall of 9,000. He needs to increase 9,000 to achieve his long-term goals. For the short-term, like I said, 31,000. I really don't know whether his cash flow would allow him to invest that or not. He needs to really look at that. So while I totally agree with you that it looks like the 3 crore 20 years from now may not be enough, but as I said, I think he needs to really look at what his expenses are, consider inflation, or if he can give us his entire breakup of expenses and income, maybe we can help him set the target. So this is as far as this investment portfolio is concerned. SBI Max Gain, well, whether it's a good idea or not depends on the additional money that he has, or the surplus money that he has. It's quite a big sum. It depends on what is the time horizon for which this can be invested. Now, if it is available only for short term, maybe it requires for a certain purpose, then maybe this is a good idea. But if this money can be invested for next 5 years or 10 years, because it's not mentioned for how long this money can be invested, then I think it would make sense to really make it a part of his investment portfolio. Because what this account will do for him is, it will reduce his interest liability to an extent. But that doesn't serve his purpose, because if he invests for the next 5 years, 10 years, if this money is available for that long period, then I think the returns can be far better. So he needs to really look at for how long this money is going to be kept aside. If it is long term, as I mentioned, make it a part of your portfolio. And then if he requires more money to be invested, this 30 odd lakhs, I think is going to make a huge role in the kind of corpus that he can create over the next 15-20 years.
Okay, an in-depth analysis of your portfolio and whether or not they will be able to achieve your predefined goals. And like Hemant said, it's great to first start off where you want to be in the next 10, 15, 20 years, and accordingly work yourself backwards and then choose your funds, portfolios, etc. Okay, next up we have Firoz, who has sent in a question. He says, would you advise putting money in liquid funds post the news from SEBI? I heard on the Money Show that the returns may get a bit hit because of the news. When I accumulate too much money in my savings account, I transfer that to a liquid fund from Kotak. Should I continue with that strategy? Firoz? Hemant?
Well, I think there are a couple of things. If you really look at what SEBI has been doing over the last few months, I think they made a lot of changes. In the month of March this year, they made a few changes for debt funds, which obviously include the liquid funds also. What they said is any security which has a residual maturity or a maturity of 30 days or more will have to be marked to market as against 60 days limit earlier. So the whole idea was to make NAV realizable closer to the realizable value of the assets of the fund. So that was one thing. And for any securities which are for less than 30 years, they said the valuation on the basis of monetization will continue. But in the recent board meeting on 27th of June, they made few more changes. What SEBI has said is that no more amortization in any of the debt fund, which includes liquid fund, which clearly means that every single security which is there in the portfolio of debt funds will have to be marked to market. So clearly, as you will see, that the NAV will reflect the true value. There are a couple of other things, especially which have been done for liquid fund. One is that 20% of the money has to be invested in, cash or near cash securities like government securities or T-bills or repo on government securities. So 20% of the money has to be invested. The purpose is that in case the money is required, the fund manager can actually liquidate the assets very clearly. There are a couple of caps which have been changed in a sector the fund cannot invest more than 20%, which is today at around 25%, and in combined exposure to housing finance companies or NBFCs cannot be more than 30%, which is 35%. So clearly, the objective of SEBI has been to make sure that the NAV reflects the true value of, and it's easier for the fund manager to realize liquidate the assets of the fund. Clearly, when you have put these restrictions, it will impact the return. There is no doubt about it. But I think the attempt here is to make funds true to label, and as I mentioned earlier, to make sure that you get your true worth of the money as and when you want to require it. So I think it will impact your return definitely, but I think it will make funds more true to label. His strategy of investing from, moving money from saving bank to liquid makes sense. But I think many times I've seen investors put money in liquid fund for a year or maybe even longer. I think it's important that you keep only that money which you may require in the short term, or maybe it could be your emergency fund. But any money which can be kept aside for longer term could become actually a part of your long-term portfolio. So I think keep an eye on how much money is there and whether you actually need to keep that much money liquid or not. Any part which has to be remain liquid can continue in the liquid fund, or there may be even, you can look at low duration or even ultra short-term funds. So be very clear about your time horizon and then decide where your money has to be invested.
Okay, I hope you've taken note of that, strategy, Feroz. Next up, we have Ashwin, who's joining us all the way from Australia. Hi, Ashwin. Pleasant to see that, you're still awake. I'm not sure what the time is actually. It may be around 9-10 p.m. But yes, you're still awake watching ET now. Tell us, what's your question, Ashwin?
Hi, it is close to 10:20 to answer your question. The question I had was, I'm looking at a bit of an aggressive savings plan. So I wanted to know, to get to 1 crore or 1 CR in 5 years, which funds and which mutual funds and what should be the SIP. I'm still getting used to the mutual fund terminology in India, but I mean the 3 funds I currently have invested in is the Mirae Asset Large Cap, the Axis Mid Cap Fund, and the Motilal Oswal Multi Cap 35.
How much roughly are you investing in these? Have you invested in these funds?
Look, not much. It's probably, the portfolio is close to 10 lakhs at the moment. So, but I wish to grow it as quick as possible.
Okay, all right. He has a clear-cut 1 crore goal that he wants to reach for his purposes. Hemant, what would you advise? How would you advise him to go about?
I hope I heard the time horizon of 5 years he said, right? Did he say 5 years?
He said 5 years. Also, Hemant, if you have any counter questions, like if he has any regular source of income, etc. as well, if you could ask him that.
No, I think what is important is for any investment decision that you make is your time horizon and how exactly are you going to be investing. So if the investment is being made on a monthly basis or on a lump sum basis, I think my view is that if it is investing on a regular basis, 5-year time horizon, if you really see your average holding period is going to be around 2.5 years. So I would not really recommend, even though your target is very aggressive and I don't know how much you can invest, but for a time horizon of, let's say, average holding of 2.5 years, investing entire money in equity may not be a great idea, because what you need is at least 5 year or more time horizon. That's a duration basically for which you can keep the money invested. In that case, my recommendation would be maybe you can have couple of large cap funds. You already have Mirae large cap fund, which is a good quality fund. You can continue with that, but I will certainly not recommend investing in a mid cap fund, especially if you're investing through on a regular basis. But if it is a lump sum money, then I think it's fine. You can invest in equities. Clearly the assumed rate of return can be around 12%. Since I'm not aware, if you can know how much money is already invested.
I'm sorry, Hemant, I did not get that. Did you have a counter question?
Yeah, I just want to know how much money has already been invested.
Okay, I think he mentioned 20 lakhs. Do we have Ashwin still right now with us on the phone line? Because I think he mentioned 20 lakhs roughly that has been invested in those 3 funds that he mentioned.
Well, I think if we're talking about 20 lakh and we really don't know whether he's going to be investing more money or not, it's very, very difficult to say whether his target of 1 crore can be achieved, but I think it's very, very aggressive if I consider only 20 lakh as an investment. So my view is that I will not recommend investing 100% into equities. He needs to maybe look at a couple of hybrid funds. Investing 100% in equity is not a great idea for a time horizon of 5 years.
Well, yeah, and there's a lot of risk as well associated with that. So sometimes when you chase all of these high return instruments, the risk as well associated with that is equally high. So you need to be a bit cautious about that. Very aggressive objective that he has. Ashwin, I hope we've been able to answer your question. Next up, we have Sanket, who's joining us from Thane on the phone line. Hi, Sanket. Good evening. What's your query?
Hello.
Yes, Sanket. Hi. Good evening. What's your question?
I am investing in UTI Ultra Short Term Fund.
Okay.
But recently, due to that DHFL issue, the returns are around 3%.
Okay.
So should I continue investing in that? That is the one question.
Okay.
And second is, I am doing SIP of 3,000 in Kotak Liquid Fund, 3,000 in Kotak Standard Multi-Cap Fund, and 4,000 in Mirai Asset Fund. So is it the right choice of the fund? These are my two questions.
So in total 4 funds, just to reiterate again, we have the UTI Ultra Short Term Fund. There the returns are a little less because of the whole DHFL scenario. There's another SIP in the Kotak Liquid Fund, an SIP in a Kotak Standard Multi-Cap, and then there's Mirai Assets as well. So this is the composition. Hemant, what would you recommend he do? Any chops or changes that you would suggest over here?
Well, clearly, if you talk about UTI Ultra Short Term Fund, I mean, he's already taken the hit because the fund had to write off that money. Clearly, the damage is already done in the sense he's already lost a part of that. That's why his return is only 3%. My recommendation would be that you can continue with the fund. Obviously, you need to look at the rest of the portfolio. My view is the rest of the portfolio looks fine to me. You can continue with that because there are chances that if there is some recovery made, you will actually get the benefit of that, because if you exit, you will not benefit if the fund manages to get some recovery. So that's one. The rest of the funds, I think Kotak Liquid Fund, you can definitely continue investing through SIP. Kotak Standard Multi-Cap, I would say, is one of the best in its category, so certainly that deserves to be there in the portfolio. And on the Mirai Fund, since there is no mention of the fund, I'm assuming that if it's a large cap fund, again, I think one of the best fund in the large cap category. So you can continue investment in those three through SIP. Be very clear that while you're investing in a liquid fund, is it that you require some money or you're trying to build some, emergency fund for yourself? Be very clear as to why are you investing in a liquid fund. But as far as the Kotak Liquid Fund is concerned, it's a good fund. You can continue with that. But we must be very clear as to what our goal is. Are we investing for the short term? Because if this money can be invested for slightly longer term, there can be better options for you.
Okay, I hope, that has been able to answer your question. Thank you then for calling in, Sanket. And of course, do continue staying tuned to The Money Show. We'll come up with new topics every day for your money. On that note, Hemant, thank you as well for joining in and very patiently answering all of those questions and queries we have received from our viewers. Well, that, of course, was our Ask the Money Show segment filled with calls right from Thane to Australia. Let's, for now, talk about our term of the day and Mythbuster segments. Today, the jargon that we are simplifying is no claim bonus. Our very first topic today was insurance. We received a question as well on no claim bonus, or NCB as it's commonly called. Now, what exactly is it? It's a discount premium in the premium offered by insurance companies. So if you're paying, say, 5,000 rupees insurance, there'll be a certain percentage that the insurance company will cut off from you. Now, when will that be? This is when the owner does not make a single claim during the policy term. So if in case you have an auto insurance and let's say you have had a good year, you've not had any accident or there's been no dent in your car and you've not had to go, to the mechanic or to repair your car, so you've not had to claim any insurance, that means after the next policy period, in the next policy period, you'll get a discount on the policy amount that you'll have to pay. That's what no claim bonus is. That was our jargon simplified of the day, but we're also about busting the myths. So for that, we'll once again go through an insurance myth that's commonly there. The myth that is often asked is one has to pay for motor policy on their own and then go through the processing hassles. Well, no, you always do have the option of cashless insurance. There are a couple of insurers that do offer you cashless claims. You do not, in fact, have to pay a penny when you are getting your repairs done. There is, however, the option of paying the money and then getting the reimbursement later. But like you heard out in our very first segment, we had Mukesh who said that it often is quite a hassle to get a claim from an insurance company. Always ensure that cashless is the right way to go, is the easier way to go, if not the right way to go. So do try and always opt for a cashless policy. That's all we have on this edition of The Money Show. Of course, do come back tomorrow. If you guys especially have kids, we have something very, very special planned for you.